In part of the course, we will talk about company valuation, why it is necessary, and what influences a company's valuation. We will lay the groundwork for what's about to come next, a few chapters that will show you how to value a company in practice. So, let's start with the million-dollar question. Why value a company? When does a firm need a price tag? In reality, valuation is an important tool in a number of situations that may occur in a company's life. It can be useful in mergers and acquisitions, subsidiary sales, startup investments, establishing a joint venture, an IPO, delisting from the stock exchange, and the list goes on. Imagine the following situation. Say you're lucky enough and you have a startup company that has attracted the attention of a willing investor. Inevitably, during the negotiations, the investor would want to know how much of your company is available and what is the price you expect to be paid. If you give too high a number, he will find startup number 2 and the negotiations end there. If you give too low a number, you will give away your firm. What's the right thing to do then? Yes, I'm sure you agree with me. We need a proper valuation that will show us the firm's worth in an objective and unbiased manner. The same example can be made for M&A transactions and IPOs. Both parties, the buyer and the seller, must have a precise idea about pricing. Let's take an investor's perspective. If you were an investor, why would you want to buy a company? Because they make great soft drinks and are called Coca-Cola? Or because their stock promises a good return on investment? I hope it's the second option. Every investor's main objective should be to make money. So, let's think of the following situation. I want to buy shares in a company traded on the stock exchange. What is the cost to do that? I will have to make an initial investment, purchase the shares from their current owner. And what is the benefit I will have after acquiring the shares? The stock will pay dividends regularly, and if everything goes as planned, it will increase in value. On your screen, you can see my investment horizon. I buy the stock today and experience a negative cash flow. In the next few years, I will hold the stock and will receive a regular dividend payment, as this is a mature and profitable company. And then, when the market is good and I decide the right moment has come, I will sell the stock to its next buyer and will hopefully benefit from the market's price having increased in the meantime. One can rightly point out that whether or not I will buy a certain stock is related to 3 variables: purchase price, dividends, and selling price. It has to be true. These are the 3 parameters that will determine an investor's rate of return. But hold on. What about the next investor? How does he determine the price he will pay for the company's shares? He uses the exact same reasoning, right? He's interested in the stock's future dividends and the price at which he can sell the stock to the next investor, and so on. If we reiterate this process a few times, we will inevitably come to the following conclusion. The price of a stock today is a function of the sum of the dividends the stock will pay in the future. That's it. It's very simple and makes perfect sense. The investors who will invest in a stock will measure its price by estimating the value of the dividends the stock will pay in the future. Very well, we are almost there. We need to answer one more question, though. What is the main driving force that determines a company's dividends? If a company makes no money, its management would have no choice but to slash dividends and communicate that the firm is going through some tough times. In a different context, if a company's business is growing and it needs to reinvest the cash it makes, it won't be able to distribute dividends. So, cash flow, the money a company makes, is the main driving force that determines dividend payments. And given that a company's share price is a function of its expected dividends, we won't make a mistake if we conclude that a company's share price depends on its expected future cash flows. Right, so at this point, we've learned the most important concept in company valuation. A company's value is a function of its future cash flows. In this lesson, we'll go a step further and we'll determine what drives future cash flows. Here we have an approximation of a cash flow calculation. Revenues minus costs minus investments equals operating cash flow. Some of the money that comes in under the form of revenues is used to pay expenses and make investments. Therefore, at the end of the year, the firm can keep only a portion of the money that came in as revenues. This portion is called cash conversion ratio. The graph suggests there are two main ways to increase a company's cash flows: grow its revenues or improve its profitability. Why would we expect a higher cash flow if we grow revenues? Well, think of it in the following way. We will have a bigger pie chart with the same conversion ratio. Therefore, the amount of cash flow produced would improve. And why can we expect to make more money if the company improves its profitability? The new pie chart will have the same size, but its conversion ratio would improve. Hence, the overall operating cash flow will be higher. The end result of both events is the same: higher operating cash flows, which leads to an increase in the dividends received by shareholders and a higher valuation of the company. Let's say it again: the two functions that drive a firm's future value are its growth and profitability. This is a key concept that will help us a great deal when valuing a company. The two main factors that determine a company's value are its future growth and profitability. All right, excellent. We know that a company's value is a function of the cash flows that the business is expected to produce. In this lesson, we'll learn the mechanics of how these cash flows can be calculated in practice. We need to start from a measure of operating profitability, like NOPAT, standing for Net Operating Profit after taxes. Why start from NOPAT and not from net income? Well, NOPAT is more suitable for valuation. It does not consider the financial structure of a firm. The interest expenses of the company are not included in the calculation we see here. We simply start from revenues, subtract COGS, operating expenses, and D&A. Then we get to EBIT and apply an operating tax rate to calculate taxes, which gives us NOPAT. We didn't subtract interest expenses and didn't apply their tax shield deductions. Why is that? Our goal is to calculate the company's unlevered free cash flow. This is a cash flow measure that does not depend on financial structure. The reason for this lies deep in the roots of corporate finance. There is a theorem written by Franco Modigliani and Merton Miller. This theorem suggests that in an efficient market, the value of a firm is unaffected by how the firm is financed. Therefore, at least at this stage, we want to calculate the firm's unlevered free cash flow, disregarding interest expenses and starting from NOPAT. We shouldn't forget a very important detail, though. Depreciation and amortization are non-cash expenses. They are an accounting artifact applied to account for the using up of tangible and intangible assets. We'll need to add them back, as this is a cash flow calculation. The reason we're subtracting D&A once and then adding it back is the calculation of operating taxes. D&A is a tax-deductible cost, right? Hence, it needs to be considered when calculating taxes. All right, perfect. Let's look at the firm's balance sheet. I would like to open a bracket here and suggest you look at the supporting materials that come with this lesson. If you have doubts regarding cash flow calculation and the calculation of cash movements of balance sheet items, you can go through the PDF files we've provided and everything will become crystal clear. Let's move on with the rest of the unlevered cash flow calculation. Next on our list is dealing with the three components of working capital: account receivables, inventories, and trade payables. Then we will consider capital expenditures, commonly known as CapEx. Capital expenditure is the cost sustained by a company to replace old PP&E or acquire new PP&E. A reasonable assumption is that a growing business will need additional PP&E investments. And finally, we will have to consider other operating and non-operating assets and liabilities. The key topic is operating versus non-operating. When can we consider an asset as operating? When its output contributes to the ongoing operations of a business. When the business uses the asset for its core activities. Once we've defined operating and non-operating assets, we can move further and do the following. The change of operating assets and liabilities will produce cash movements included in the cash flow statement. Non-operating assets and liabilities are not used for the generation of operating cash flows, and their value, be it positive or negative, should be added or subtracted to the company's enterprise value and shouldn't be considered in the calculation of the company's unlevered free cash flow. Let's recap. To calculate unlevered free cash flow, we will start from NOPAT. Add back D&A. Consider the movement of working capital items, CapEx, and other assets and liabilities. And this gives us unlevered free cash flows that are available to both debt and equity investors. We've learned the main drivers behind company valuation. Every firm's value depends on its future cash flows. The higher the expected cash flows, the more expensive the firm, right? But what if we compare two companies whose projected future cash flows add up to the same amount, as shown in the scheme we see here? The first company earns more in the initial period, years 1 to 5, while the second earns more afterwards. The absolute value of the cash flows that the two companies earn is the same. So which is more valuable? To answer this question, we need to remember one of the core principles of finance: the time value of money. It is based on the concept that $1 today is worth more than $1 tomorrow. Money you hold now is worth more because you can invest it and earn interest. And this gives us the answer. The first set of cash flows is much more valuable. The cash flows that a company produces today are more valuable than the cash flows the company will produce next year or in 10 years. To account for this, we need an extra instrument, a discount factor. It would allow us to calculate the present value of the cash flows the company is expected to produce in the future. And this fits perfectly with our task, given we want to calculate the company's worth in the present day. Discounting cash flows is a core topic in financial math. If you have any doubts or would like to refresh your skills, please look at the link available in the resources section. We have no doubts about whether we need to discount the company's cash flows. But what about the discount factor we should use? Should we discount the company's cash flows by its cost of debt? Or should we use its cost of equity? Or maybe an average between the cost of debt and the cost of equity? This is a subtle question, and the answer is even subtler. The discount factor must be determined according to the type of cash flows we will discount. If the cash flows will be available to equity holders only, we will use cost of equity. If the cash flows will be available to both equity and debt holders, we will have to use a blend of the cost of equity and the cost of debt. The discount factor that considers both debt and equity investors is called weighted average cost of capital, or simply WACC. It provides a sense of the average opportunity cost sustained by investors for investing their funds in the firm. Let's look at the WACC formula. It has two weighting components: debt divided by the sum of debt and equity, and equity divided by the sum of debt and equity. The sum of these two components is equal to 1. This shows us that in a firm that is prevalently financed with debt, the cost of debt will have a higher weight. And conversely, if a company is financed mainly with equity, the cost of equity will have a higher impact on WACC. We shouldn't forget to mention the cost of debt component includes a third factor, 1 minus T, that takes into account the fact that interest expenses are tax deductible, and the cost of debt of the firm is lower than it seems. So, in this video, we explained why a company's cash flows must be discounted, and described the discount factor used to discount cash flows. That's great. But what about the cost of debt and equity? Are they easy to calculate? We'll find the answer to this question in our next lesson.